Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Atmos Energy Corporation quarterly report. Atmos Energy Corporation offers a range of businesses and services through its two main segments, distribution and pipeline and storage. The company's primary focus is on regulated natural gas distribution, serving approximately 3.4 million customers across 8 states. This includes residential, commercial, public authority, and industrial customers. In addition to distributing natural gas, the company also provides related sales operations and owns a significant network of underground distribution and transmission mains, spanning over 76,000 miles. The pipeline and storage segment transports natural gas for third parties and manages 5 underground storage facilities in Texas. Furthermore, this segment offers ancillary services such as parking arrangements, lending, and inventory sales. The company's extensive pipeline network includes over 57,000 miles of gas transmission lines, enabling the transportation of natural gas across various regions. With its rich history dating back to 1906, Atmos Energy Corporation has established itself as a prominent player in the regulated natural gas distribution and pipeline industry. Atmos Energy Corp's stock price has experienced a significant increase of 22.03% over the past year, driven by several positive news events and financial performance indicators. One key factor contributing to this growth is the company's strong fiscal first quarter 2026 results, which exceeded Wall Street expectations, with earnings per diluted share of $2.44 on net income of $403 million. The company has also affirmed its fiscal 2026 guidance, signaling continued confidence in future performance. Additionally, Atmos Energy's board of directors declared a quarterly dividend of $1 per share, representing a 14.9% increase over the previous year and demonstrating the company's commitment to returning value to shareholders. Furthermore, the company has outlined strategic capital expenditure plans totaling approximately $26 billion between fiscal years 2026 and 2030, which will focus on modernizing its distribution and transmission systems. This investment is expected to enhance safety, reliability, and meet regulatory compliance, ensuring long-term operational stability and growth. The favorable regulatory environment in Atmos Energy's operating regions, particularly in Texas, Louisiana, and Tennessee, has also contributed to the company's success. The supportive framework allows for mechanisms to mitigate regulatory lag, permitting the deferral of eligible incurred costs related to capital expenditures until new rates are implemented, which helps ensure a stable and predictable revenue stream. Overall, these positive developments have collectively driven Atmos Energy Corp's stock price increase over the past year, demonstrating the company's strong financial performance and strategic growth plans. Atmos Energy Corporation market capitalization of $27 billion is significantly larger than the average industry peer of roughly $5 billion. This shows that Atmos Energy Corporation holds a significant advantage in their industry. Atmos Energy Corporation trades at a higher price-to-earnings ratio of 22 times and a higher price-to-book ratio of 2.01 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 52% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 2.37%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a review of the extracted summaries. Revenue growth is primarily driven by several key factors. Firstly, distribution segment revenue experienced significant growth, increasing by 14% from $1,109,335 to $1,258,826. Additionally, residential and commercial gas sales saw increases in 2025 compared to 2024, with residential gas sales rising from $693,000 and $50,000 to $780,000. $412,000, and commercial gas sales growing from $266,000 and $54,000 to $315,000, $565,000. Furthermore, consolidated distribution sales volumes also experienced growth, increasing by plus 3,209,000 MCF. Midtech/affiliate transportation revenue saw a substantial increase of plus 21,822,000, while third-party transportation revenue rose by plus 9,553,000. These factors collectively contributed to the overall revenue growth. On the other hand, revenue decline was primarily driven by two key factors. Firstly, transportation revenues decreased from $266,000 and $29,000 in 2024 to $255,000, $390,000 in 2025. Secondly, alternative revenue program revenues also saw a decline, decreasing from minus $13,303,000 in 2024 to minus $33,400,000 in 2025. These decreases contributed to the overall revenue decline. Net income experienced a significant increase from $351,858,000 in 2023 to $402,964,000 in 2024, indicating a growth of over $51 million. However, this trend was short-lived, as net income remained stagnant at $402,964,000 in 2025. A more concerning development is the 12% decrease in net income from an unspecified amount in 2025. Profit margins also underwent changes during this period. The operating income margin decreased by 1.8 percentage points from 39.1% in 2023 to 38.3% in 2024, while the net income margin increased slightly from 29.9% to 30%. Within specific segments, profit margins showed mixed results, with a decrease of minus 0.3% in the distribution segment and an increase of 2.8% in the pipeline and storage segment. The reasons behind these changes are multifaceted. Positive rate outcomes driven by safety and reliability spending contributed to the growth in net income and revenue. Additionally, favorable legislation in Texas led to increased infrastructure spending, adding $35.2 million to the bottom line. However, various factors such as rising gas costs and competitive pressures also had an impact on profit margins. The company's financial performance indicates a positive trend in its operating cash flow. For both 2024 and 2023, the operating cash flow has been reported as positive, with figures of $308,058 and $282,022 respectively. This is further reinforced by the summary on page 55, which explicitly states that operating activities, $308,058,000 positive. Furthermore, an analysis of the change in net income and other non-operating items suggests a consistent pattern of positive operating cash flow, providing confidence in the company's ability to generate sufficient funds from its core operations. The company's debt level has undergone fluctuations over the past periods. Initially, it increased from $8,907,169 to $9,553,625. However, a closer look at the data reveals that this increase was followed by a decrease in debt levels compared to previous periods. Furthermore, when comparing the total debt as of September 30, 2024, and December 31, 2024, we see a slight reduction from $482,138,000 to $465,715,000. Regarding interest expenses, there is no explicit mention of significant changes in page 2 or page 6. Nevertheless, it is noted that the introduction of new senior notes with an effective interest rate of 4.85% led to a substantial change in interest expenses. Additionally, the data shows a decrease of $9,708,000 in interest expenses. The company's financial performance varied across different segments and regions. In terms of segments, the distribution segment performed well, with a 13.7% increase in revenue from $1,108,569 in 2024 to $1,258,049 in 2025. The pipeline and storage segment also showed improvement, with operating revenues increasing by 25.3% from $67,430 in 2024 to $84,536 in 2025. However, the pipeline and storage segment experienced a decline in revenue of approximately 11.9% in 2025 compared to the previous year. The distribution segment also faced challenges, with revenues earned through the first 6 months of the fiscal year being only about 70%, indicating a slow start to the year. In terms of regions, some areas performed better than others. Kansas and West Texas saw strong performance from October to May, while Tennessee experienced growth from October to April. Kentucky, Mississippi, and Mid-Tex also showed improvement from November to April. Louisiana's peak season was from December to March, but its overall performance was not as strong. Virginia had a consistent year-round performance, with January to December being the best period for the region. Management's outlook for the company is cautiously optimistic. They acknowledge that current quarter results do not necessarily reflect future performance, but are evaluating the impact of accounting pronouncements on financial statements. In terms of strategy, management plans to continue significant capital expenditures over the next 5 years, totaling $26 billion, to modernize distribution and transmission systems. This investment will focus on safety and reliability spending, with costs recovered through rate designs and mechanisms. The company is also expecting a 10.5% increase in operating income due to rate adjustments, consumption growth, and residential customer growth. Additionally, the pipeline and storage segment's operating income has increased by 15.4%, driven by rate adjustments and higher capacity contracted by tariff-based customers. Management is confident in the company's liquidity position, stating that it has sufficient funds to cover working capital needs and capital expenditure programs through fiscal year 2026. They expect to obtain financing on reasonable terms as necessary to support their plans. Overall, management's strategy focuses on investing in infrastructure while maintaining a strong financial position. The company has a history of paying dividends to its shareholders. In 2024, the cash dividend per share was $1, and the company made dividend payments totaling $160,407. This indicates that the company prioritizes returning value to its investors through dividend distributions. Regarding share buybacks, while the company mentions settling shares for net proceeds in 2024, it is unclear whether this constitutes an actual purchase of shares or simply a settlement of existing shares for cash. Therefore, it cannot be confirmed if the company has bought back shares in 2024. Concerns have been raised regarding the accumulation of inventory levels in the supply chain. A notable instance of this issue can be seen on page 59, where it is reported that inventory buildup has occurred, with a significant increase from 70.1 billion cubic feet (BCF) in 2024 to 73.9 BCF in 2025. This trend suggests potential disruptions in the supply chain, which could have far-reaching implications for businesses and industries relying on these resources. That concludes the financial summary for Atmos Energy Corporation. Feel free to comment below, and I will be happy to answer them when possible.